Good morning and welcome to the global view on this Wednesday. I'm Andrew Gagan. Great you can join us here at ausbiz. Let's first take a look at what happened on markets overnight. European equities, they fell. Investors disappointed by a lack of further stimulatory measures in China. However, stocks rose on Wall Street, reversing the previous session's losses as Fed speakers indicated a more gradual pace of monetary policy easing. Well, the IT sector led the gains on the S&P 500. Among the best performers, Nvidia, along with Palantir and Palo Alto Networks. US-listed shares of Chinese companies slid, tracking losses in domestic stocks, with Alibaba, JD.com and PDD Holdings suffering heavy losses. And despite China saying it's fully confident of achieving its full-year growth target, investor disappointment was also evident among the copper miners, which also included BHP and Rio. And the energy sector fell, slipping around 2.5% as oil prices retreated sharply following Monday's rally. And PepsiCo, it rose after the snack maker trimmed its forecast for annual sales growth, but reported adjusted earnings per share above estimates. Well, a number of Federal Reserve members have spoken of the need for a gradual easing of interest rates. New York Fed President John Williams saying the current stance of monetary policy is really well positioned to both hopefully keep maintaining the strength that we have in the economy and the labour market, and that the large 50 basis point rate cut in September was not the rule of how we act in the future. While St. Louis Fed President Alberto Musalem has said, given where the economy is today, I view the cost of easing too much too soon as greater than the cost of easing too little too late. Well, the US 2-year Treasury rose to 3.99%. The 10-year is at 4.05, which is a 2-month high. And markets are now pricing an 85% chance that the Fed funds rate will be cut by 25 basis points at the next meeting on November 7th, which is just after the US presidential election. The US dollar has held firm as investors assess the outlook for further US rate cuts, along with concerns about the conflict in the Middle East and China's efforts to support its struggling economy. And the Aussie dollar has eased to 67.5 US cents. Taking a look at commodities overnight, well, as mentioned there, oil prices have continued their recent slide on news of a possible ceasefire between Hezbollah and Israel. Brent crude futures down more than 4.5% at $77 a barrel. And the absence of further Chinese stimulatory measures has hit commodities, with copper falling around 2.5% and iron ore tumbling more than 5% to $105 a tonne. Meanwhile, the gold price has fallen more than 1%, which is its biggest fall in 1.5 months, as recent US economic data is seen as lowering those expectations of a larger rate cut. Spot gold at $2,621 an ounce. And Bitcoin, it's trading lower to be just above 62,000 US dollars. All right, well, to get across what's going on globally at the moment with some of those risks and how investors should respond, I caught up with Tim Richardson from Pengana.
Certainly was a bit of a disappointment. We saw markets go on a bit of a tear the day before and the start of the day after the Golden Week holiday. That was based on the monetary stimulus that they announced before the break and expectations of fiscal stimulus, which turned out to be a little bit less exciting than the markets had hoped for. But the market still finished up on the day, but as you say, there was a bit of disappointment there. Really, what the government in China is trying to do is trying to boost the economy to meet its 5% GDP growth target for this year and steer clear of deflation that the economy is flirting with. But the Chinese economy does face some geopolitical challenges. It's a big importer of oil. It's thought to hoover up pretty much all of Iran's oil output. And of course, China runs a really big trade surplus with the United States. That's likely to become an increasingly more important issue after the election next month, whoever wins. But at the same time, it's probably the structural issues that face China that are more important: the aging population, the property market, the unwillingness to spend on consumer goods, and the over-centralised decision-making of the government, which leads to the misallocation of resources.
Yeah, I mean, it's obviously intended to try and get domestic demand up and running, isn't it?
Very much so.
Given there's more and more pressure, particularly on its exports at this point. Look, as a result, of course, from the stimulatory measures that have already been put in place, the Chinese stocks have really rallied hard, mind you, coming off from a very low base. How are you looking at that at the moment?
With China, it's there are some big challenges, as I've touched on, with investing in the broader market index. But having said that, there are some really strong, well-managed companies that are worth looking at. And you'll hear investors say, "Oh, China's uninvestable," but I wouldn't hold with that. Not investing in an economy and a market as big as China itself carries certain investment risks. I think the thing with investing in China, it's a case of identifying those really well-run, well-governed stocks that are in parts of the market that the Chinese government frankly approves of. If you're in EVs, cybersecurity, for example, the government will probably leave you alone to do what you do. Whereas if you're in things like video gaming, you might wake up one day and find the Chinese government is no longer your friend, and there's a big political risk that you're going to be facing. And it's also important to look at company supply chains. Do they source key components from the West? Does their finance come from the United States? Are they exporting to Western markets? Those sorts of businesses attract a bit of a risk premium.
Now, I mean, you mentioned its reliance on oil, in particular from Iran, and there's a big question mark over that, of course, because of what's going on in the Middle East with expectations perhaps that Israel could target Iran's oil facilities. How are you seeing that play out at the moment?
Well, there's certainly an elevated level of risk in the market at the moment. Perhaps intriguingly, it's had less of an impact on the global equity market than we might have expected. I'd put that down to the fact that partly major global companies tend to have very little direct exposure to the countries immediately affected by the current events, and it's rather more through the oil price mechanism that the risk comes through. But interestingly, the oil price is only a few dollars higher than it was 12 months ago before the current conflict started. That reflects the way the global economy has transitioned away from oil over the last few decades. The world was in a very different place during the 70s and 90s, where we had those Middle East conflicts, and that had a huge impact on oil. The world's decarbonising, we're moving to green energy and EVs, so that's impacting the demand for oil.
Just on that point, do you feel as though perhaps it's less likely that, given where the oil price is at the moment, despite it has risen quite substantially, that there's some concerns that it may reinvigorate inflation? Is that likely or not, do you think?
Well, it depends what the oil price does.
Yeah.
As long as it's well behaved, not really. The danger would come if most analysts expect Israel to respond in some shape or fashion to the missile attacks launched by Tehran last week. If those are restricted to military facilities, or perhaps a token warning shot against some oil installations, the oil price will probably remain under control. Were Israel to launch an all-out attack on the oil facilities, that would likely result in retaliation on more pro-Western government's oil facilities, then that would be a different environment, and the oil price could certainly jump up, and eventually that will feed into inflation.
Now, of course, you mentioned earlier the US election, less than 4 weeks away now. And we were talking before we started this of the coin toss, that is the potential outcome there. What sort of risk does that pose to markets at the moment, do you think?
Historically, you tend to see share markets sell off ahead of a contested US election where the outcome's uncertain, which is certainly the environment that we're in now. But historically, what we've always seen is that after the election, whoever wins, markets tend to recover, and there's probably good reasons to to expect that to play out on this election cycle as well. There are certainly some policy differences in terms of the approach to central bank independence, concern for managing inflation and tariffs, which do have a potential impact on markets. But trying to forecast these in advance is very tricky. And when investors try to position ahead of elections on a sectoral stock basis, it tends to go wrong more often than it goes right. For example, during the Trump presidency, energy was pretty much the weakest performing sector, which was rather surprising considering his pro-fossil fuel policies. But equally, during the Biden administration, despite an agenda that was very much focused on green energy and EVs, the energy sector, which is predominantly focused on fossil fuel companies, performed very, very strongly indeed. So so making bets ahead of time is probably not a good idea.
Well, then on that point, more broadly, from an investor perspective, do you need to reposition into an event like that?
No. It's trying to forecast the outcome of these binary events is close to impossible and can be very hazardous for a share market portfolio. Investors tend to do better when they build a diversified portfolio of quality companies that are able to grow earnings in any geopolitical environment, and sticking with that strategy that tends to work better.
Tim Richardson from Pengana. Okay, let's focus then locally. Just before we get underway for the Open, we can see looking for a positive start here. SPI futures up around 0.1%. So once again, the focus will be on energy and also those material stocks, given what we're seeing both out of the Middle East and also China. Stay with us for the Open.